So, imagine finding a loophole where a company just hands you free cash for holding a stock for a single day.
Right, like a literal glitch in the matrix.
Yeah, exactly. I mean, you buy 1 million shares on a Tuesday, you collect this massive cash payout on Wednesday, and then you just sell the stock on Thursday.
It sounds illegal, honestly, or at least highly suspicious.
It really does. But today, we are looking at why the market mathematically prevents that exact free money glitch and how understanding that one specific mechanic completely changes the way you look at building wealth.
Yeah, it completely shifts your perspective,
Yeah.
From seeing the market as this giant casino to recognizing it as a highly efficient machine.
Welcome to the Franks Report. I'm Jessica.
And I'm Philip.
We are so thrilled you're joining us for this deep dive.
Yeah.
Our mission today is to, well, break down market mechanics from the absolute ground floor.
Right, specifically focusing on the foundation of the financial markets, which is equities.
Exactly. We are going to unpack the reality of what it means to actually own a stock. But real quick, before we jump into the mechanics, just a reminder to hit that follow button wherever you are listening so you never miss our future content.
And if you really want to take your market knowledge to the next level after this foundational discussion, you definitely need to pick up a copy of our new book.
Oh, absolutely. It's called The Funded Micro: Modern Future Strategies for the Prop Firm Era.
It is an essential read for anyone serious about navigating today's markets. But, I mean, to even begin to understand those modern complex strategies, you have to understand the underlying asset.
Right. You have to understand equities.
Exactly, because everything else is built entirely on top of them.
So let's start by shifting how we actually visualize a stock. Because it is so incredibly easy today, especially with, gamified trading apps on our phones, to just see stocks as these 3 or 4 letter ticker symbols.
Oh, totally. They just look like gambling tokens blinking red and green on a screen.
Yeah, completely detached from reality. So we need to transition that mindset right now. When you buy a stock, you aren't buying a digital token.
No, you're buying a literal, legal piece of a business.
Yes. That mental shift is crucial.
It really is. You aren't just betting on a price movement. You are acquiring fractional ownership. I mean, the total ownership of a publicly traded company is divided into units called shares.
And all the shares outstanding combined represent the entirety of the company's equity, right?
Precisely. So when you purchase even a single share, you enter into this binding relationship with that corporation. You now hold what is called a residual claim on the business.
Okay, let's unpack this term, residual claim, because while it sounds a little academic, the mechanics of it are actually fascinating.
They really are.
Having a residual claim is essentially like being the very last person in line to get a slice of pie if a bakery goes out of business.
That is a great way to visualize the risk structure, honestly.
Right.
Yeah, because when a company is liquidated in bankruptcy, there's a strict legal hierarchy for who gets paid from the sale of the assets.
So who gets paid first?
Well, the creditors, the bondholders, the suppliers, and the employees, they all get in line first. The shareholder is at the absolute bottom of that priority list.
Right, so if the bakery goes bankrupt, they sell off the industrial ovens, they sell the display cases, the delivery vans.
The bank gets their loan paid back first. Always.
Always. So by the time they get to you, the shareholder, there might not be any pie left. I mean, you literally get nothing.
Which happens a lot.
It does. But, and here's where it gets really interesting, in exchange for taking that massive risk at the back of the line, you own the entire bakery's profits if it becomes a massive global success.
Exactly. The unlimited upside during periods of corporate growth is your direct reward for accepting that residual risk.
It's a trade-off.
It's the ultimate trade-off. You're absorbing the maximum amount of risk in the capital structure, which, legally entitles you to the maximum potential reward.
And when we talk about this specific kind of ownership, we're almost always referring to common stock, right?
Yeah, common stock. It's the most frequent type of equity issued to the public, and a key feature is that it typically carries voting rights. One share generally equals one vote.
So you actually get a say in how the bakery is run.
You do.
But surely there are investors who look at that residual claim, they look at the back of the bankruptcy line and say, no thanks, I want a little more security.
Oh, absolutely.
Because I know some traders absolutely refuse to deal with voting rights and just want to skip ahead in the line. And that's where preferred stock comes in.
It is. Preferred stock occupies this really interesting middle ground between equities and bonds. It still represents ownership, but it completely strips away those voting rights.
Okay, so you give up your operational voice.
Right. And in exchange for giving that up, it offers a fixed predictable dividend and a higher legal claim on the company's assets than common stock.
So in the bakery disaster scenario, the preferred shareholder cuts in line ahead of the common shareholder.
They do, but they still have to wait behind the bank and the bondholders.
Got it. So it's structured for an entirely different type of investor.
Precisely. It's for someone who prioritizes consistent, predictable income over having a voting influence on corporate policy or, chasing massive growth.
So what does this all mean for the person logging into their brokerage account right now? Now that we understand we legally own a piece of the business, how does that ownership actually generate wealth?
Right, getting to the good part.
Yeah, that brings us to the two distinct profit mechanisms in the equity markets. The first one is the one everyone knows. It's the one that dominates the financial news: capital appreciation.
Yeah, capital appreciation is the primary driver of retail interest. Simply put, it occurs when the market price of a stock increases above your purchase price.
You buy low and you sell high.
Exactly. But the mechanics behind why that price moves are dictated by the ruthless laws of supply and demand.
And that demand isn't just random. It's influenced by the company's underlying performance, broader macroeconomic conditions, and frankly, raw investor sentiment.
Sentiment plays a huge role.
Right. If a company develops a groundbreaking new technology or they release an earnings report showing massive quarterly profits, the market reacts.
People want in.
More investors want to buy that stock. So that increased demand against a fixed supply of outstanding shares mechanically drives the price higher.
But there is a huge psychological caveat here that trips up a lot of new investors. We have to clearly define the difference between an unrealized gain and a realized gain.
Oh, this is so important.
Capital appreciation is entirely a paper gain until you actually execute a sell order and close the position.
This is such a critical distinction. Let's say you purchase 100 shares of a company at $50 a share. Your initial investment is $5,000.
Okay, tracking.
If the price rises to $75 a share over the next year, your position is now worth $7,500. You have an unrealized gain of $2,500.
Which looks great on the screen.
It looks amazing. You open your app, you see green, and you feel $2,500 richer. You might even go out and celebrate.
You might feel richer, but you don't actually have that money yet. If the market hasn't paid you,
right,
that gain only becomes realized and consequently taxable once you actually sell those shares on the exchange and convert them back into hard cash.
Because until that exact moment of sale, the price could just as easily fall back to $50 or even plummet lower.
The market giveth and the market taketh away.
It really does. Though unlike fixed income instruments like bonds that have a strictly capped return, the potential for capital appreciation in equities is, well, theoretically infinite.
There's no ceiling at all.
Right. The stock can keep going up forever as long as the company grows. But of course, it comes with the very real residual risk of the stock price falling all the way to zero.
Which is terrifying.
Completely terrifying, but it's the nature of the beast. Now, let's talk about the second way to win, which feels a lot more tangible than just watching paper gains fluctuate on a screen.
Dividends.
Dividends. This is where a corporation literally shares a portion of its real-world profits directly with its shareholders.
It is cash deposited directly into your brokerage account, and it's yours to keep, regardless of what the stock price does the next day.
But it's important to understand why some companies pay them and others don't. Because many younger or high-growth firms, like think of a brand new tech startup, they prefer to take all of their earnings and reinvest them right back into the business.
Because they need that cash to fuel massive expansion.
Right. They're building new factories, they're hiring top engineering talent, funding heavy research and development.
Yeah, their ultimate goal is massive capital appreciation. So giving cash away to shareholders doesn't make any strategic sense for them.
Exactly, but established companies, the legacy blue chip brands that already dominate their industries and have incredibly stable cash flows, they don't necessarily need to reinvest every single penny to maintain their market share.
So they reward their shareholders through regular cash payments, usually on a quarterly basis, quoted as a specific dollar amount per share.
And managing these dividend-paying positions isn't just about buying the stock and waiting. It requires understanding the mechanics of the dividend life cycle.
Which has 4 critical dates.
Right, 4 dates. The first is the declaration date. This is simply the day the company's board of directors formally announces to the public the exact dividend amount and the upcoming payment schedule.
That part is pretty straightforward.
It is. But the second date is one that causes massive confusion, and it's the ex-dividend date.
Yes, the strict rule here is that you must own the stock before this date to get paid the dividend.
So if you buy the stock on or after the ex-dividend date, the previous owner gets the cash.
Correct.
Okay, so this is where I need to push back, because this brings us to the glitch I mentioned at the very start of the show.
The free money glitch.
Yes, because when I first learned about how dividends work, I thought I had discovered a massive loophole.
Most people do.
Right. Because if I know a company is about to pay out a $2 per share dividend tomorrow, why wouldn't a short-term trader just buy 1 million shares today, collect the $2 million dividend tomorrow, and then immediately sell the stock? I mean, isn't that just free money?
It's a brilliant question, but it highlights exactly why the market is a mathematically closed system. There is no free money glitch.
Okay, so why doesn't it work?
You have to look at the company's balance sheet. The cash for that dividend is literally leaving the company's bank accounts to be paid out to the shareholders.
Right.
Therefore, the company itself is mathematically worth less than it was the day before.
Oh, because millions of dollars just walked out the front door.
Precisely. To account for this, the financial exchanges automatically adjust the stock price downward by the exact amount of the dividend when the market opens on the ex-dividend date.
Wait, really? It's automatic?
It's completely automatic. So if you buy a stock at $100 the day before a $2 dividend, on the ex-dividend date, the stock opens at $98.
Wow.
Yeah, so you get your $2 in cash deposited later, but your shares are now worth $2 less. You've broken exactly even.
The market really doesn't miss a trick. It completely neutralizes the loophole mechanically.
It's a highly, highly efficient system.
Okay.
So, moving through the rest of the life cycle, the third date is the record date.
Which is usually 1 business day after the ex-dividend date, right?
Yes, it's purely an administrative step where the company checks its books to officially record who the shareholders of record are. And finally, you have the payment date.
The best date.
The best date, by far. It's the day the funds actually clear and hit your account.
And when we talk about evaluating these payouts, we use a metric called dividend yield. This is calculated by dividing the annual dividend per share by the current share price.
So if a stock is trading at $100 and pays an annual dividend of $4, its yield is 4%.
Right. But I want to highlight something really dangerous here that traps a lot of new investors who are searching for income, and that is the high yield trap.
Oh, the high yield trap is devastating if you don't understand the underlying math.
Yeah, because a high percentage yield might look like an incredible income opportunity. I mean, you might see a stock offering a 15 or 20% yield and think it's a total gold mine.
But it's rarely a sign of health.
Never. Because the yield is a fraction based on the current share price, if a company is in massive financial distress and its stock price completely crashes, the yield mathematically spikes.
It's an optical illusion, basically. The yield appears artificially high, but the underlying business is likely failing.
And they are probably about to cut or completely suspend that dividend anyway.
Exactly. A sky-high yield is almost always a red flashing light, not a green one. It demands immediate investigation into the company's financial stability before you invest a single dime.
So true. So ownership and dividends give us the financial benefits of equities, but earlier we established that common stock gives you voting rights.
Right, which introduces an entirely different dimension to the market.
We are moving from the raw math of balance sheets to the literal politics of running a corporation. Corporate governance.
Yeah. Holding equity gives you a literal, legally protected voice in how a company is managed.
Now, obviously, it's true that a retail investor holding a few hundred shares has limited individual influence compared to, a massive institutional giant holding millions of shares.
Sure, but the cumulative power of retail shareholders is a core component of market transparency and corporate accountability.
And the primary battleground for this power is the AGM, the annual general meeting.
Yeah, that's where shareholders vote on massive company-altering issues. We're talking about executive compensation packages, the election of board members, and whether to approve or reject potential mergers or acquisitions.
And historically, you had to attend these meetings in person to cast your vote, right? Which effectively boxed out the average retail investor.
It did. But in the modern trading environment, most voting is done by proxy.
Which is so much easier.
Way easier. Your broker will seamlessly send you digital documentation, allowing you to review the proposals and cast your vote online right from your phone.
I love the concept of proxy voting. To me, it functions like a digital check and balance system, but one that has actual legal teeth. It prevents CEOs from acting like untouchable kings.
Exactly.
Like, let's say leadership is trying to push through a massive, totally unwarranted golden parachute for themselves while the company is bleeding money and laying off workers. The shareholders can literally band together and vote it down.
That is exactly the intended purpose. It protects you, the actual owner, from what is known as management entrenchment.
Ooh, management entrenchment. What is that?
It's this highly toxic scenario where company leaders make selfish decisions that benefit themselves.
Like protecting their own jobs?
Protecting their jobs, resisting innovation, or just padding their compensation, all at the direct expense of the shareholders.
Wow.
Yeah. The cumulative voting power ensures that management remains a servant to the owners of the business, not the other way around.
It's incredibly empowering when you realize your brokerage app is essentially a voting booth for corporate America.
It really is.
But realistically, the weight of your vote and the risks you take to cast it change drastically depending on the size of the pond you're swimming in.
Very true.
Because knowing how to vote and how to make money is completely useless if you don't know what kind of company you're buying in the first place. Let's look at how measuring a company's size dictates its entire risk profile.
So the metric the market uses for this is market capitalization, often just abbreviated to market cap.
And it's a very simple calculation, right?
Very simple. You just multiply the current share price by the total number of outstanding shares. This gives you the total real-time market value of the entire company.
And based on that final number, the market sorts companies into different tiers. Let's walk through this sort of menu of options you have as a retail investor.
Okay.
At the top of the food chain, you have the large cap companies, typically valued at $10 billion or more.
And these are often referred to as blue chip stocks. They are the established, deeply entrenched industry leaders.
Think of massive multinational corporations with decades-long histories of stable earnings.
And very frequently, those consistent dividend payments we discussed earlier.
Right. Then you drop down a tier to mid-cap companies, which are generally valued between $2 billion and $10 billion.
These offer a really interesting balance. You get some of the operational stability of a large cap, but they still have plenty of room to grow rapidly and capture new market share.
Makes sense. And finally, you have small cap companies, which are valued under $2 billion. These are often newer, highly niche-focused businesses.
Yeah, they offer the absolute highest potential for massive capital appreciation, but they are notoriously volatile.
And that volatility connects directly to the specific types of risk inherent in equity ownership. Because while equities offer tremendous potential for wealth creation, the risks are unavoidable.
Unavoidable. And they behave differently depending on the market cap. The most prominent one is market risk.
What does that look like?
It's the possibility that the entire stock market declines, pulling even perfectly healthy, wildly profitable companies down with it.
Because if the tide goes out, all the boats drop.
Exactly. Market risk is usually driven by massive macroeconomic factors that no single CEO can control. Think of aggressive interest rate hikes by the central bank, or sudden geopolitical instability.
Then you have business risk, which is completely isolated to the specific company you bought.
Right.
I mean, even in a booming, euphoric market, if the company you own makes catastrophic management decisions, or if consumer demand for their flagship product suddenly vanishes or a competitor disrupts them, that specific stock will lose massive value.
That's a vital distinction. And finally, there is liquidity risk.
Which is terrifying.
It is the terrifying inability to sell your shares at the current market price, simply because there are not enough buyers on the other side of the trade. You want to sell, but the market is completely silent.
Now, wait a second. Let's clarify this. Does that mean if I buy a massive blue chip stock, I might get stuck holding it because no one wants to buy it for me? Are blue chips completely safe from this?
Let's delineate these risks clearly. For a large cap blue chip stock trading on a major exchange like the NYSE or the NASDAQ, liquidity risk is generally minimal.
Okay, good.
Yeah, it's almost non-existent for retail-sized positions. There are always millions of shares changing hands every single minute of the trading day. You will be able to sell your shares instantly.
Right.
However, while they are safe from liquidity risk, they are absolutely still vulnerable to business risk and market risk. A legacy blue chip can still suffer from terrible leadership, and its stock will definitely drop during a broader market crash.
So no equity is completely safe from risk.
Nope.
That makes perfect sense. The risk just changes shape depending on the size of the company. Liquidity risk is really mostly an issue for those tiny, small cap or micro cap stocks, where trading volume is incredibly low and the bid-ask spread is huge.
It is. And navigating these different tiers and risk profiles brings us to the core retail strategy. When you build a portfolio, you are generally choosing to align yourself with one of two major investment philosophies.
Growth or value.
Exactly. Growth stocks are companies, often in the tech sector or emerging disruptive industries, that are focused entirely on capital appreciation.
And as we mentioned with dividends, they reinvest all their capital to capture market share as rapidly as possible.
Value stocks, on the other hand, require a totally different mindset. These are companies that appear to be trading for a price less than their intrinsic mathematical worth.
So they're basically on sale.
Basically, they are often mature companies, perhaps temporarily out of favor with the broader market sentiment, and they frequently pay those stable dividends. You're buying them because you believe the market has mispriced them.
And you're getting paid to wait for the market to correct its mistake.
Right.
It's all about aligning that menu of options, the market cap, the risk profile, the growth versus value philosophy with your own personal financial objectives and your tolerance for risk.
It is. And, as we conclude this foundational look at equities, I really want to connect everything we've discussed back to the broader financial ecosystem.
Oh, absolutely.
Because the ownership, the residual claim, the voting rights, the dividend mechanics, none of this exists in a vacuum. In the wider modern world of finance, we trade highly complex instruments like futures and options.
Which are the exact strategies we cover on our book.
Exactly. These instruments are derivatives.
Yeah.
But it's vital to understand that derivatives pull their entire value, their complete existence, from the price movements of these very equity markets.
Right.
They leverage equity price movements to create massive opportunity, but they do so without granting any of the ownership rights or voting power we've discussed today.
Wow, yeah.
You cannot truly master derivatives or any advanced market strategy without first having a profound understanding of who actually owns the underlying shares and the corporate actions that drive their foundational value.
That is such a powerful perspective. To recap our biggest takeaway today, stocks are not just random flashing numbers on a screen.
Not at all.
They are the foundational corporate actions that drive all market value. Every single share represents a real piece of a real business with real legal rights and real risks attached to it.
Understanding that completely transforms how you interact with the market at every level.
Absolutely. Well, that wraps up our deep dive into equity mechanics. We want to thank you so much for joining us. Please make sure to visit www.franksreport.com for more resources, and do not forget to check out our book.
Yes, The Funded Micro, Modern Future Strategies for the Prop Firm Era.
Grab a copy today, and of course, follow the podcast on whichever platform you are listening on right now.
I'll leave you with this final thought to mull over as you look at the markets this week. If every single share of stock represents a legal vote and a fractional voice in the future of human commerce, and millions of those shares change hands every single second of the trading day, what exactly is the market trying to say today?
We'll see you next time.